Welcome to the last video in this year's FT Deals and Dealmakers series. 2011 has not been a vintage year for the M&A world. It started well, with US corporates stealing the charge and talk of mega deals, but despite some large-scale transactions like AT&T's bid for T-Mobile and Kinder Morgan's bid for El Paso, the year has been disappointing. It's been a year of controversy too, with a shock collapse of G4S's bid for Denmark's ISS, which would have created one of the world's biggest private sector employers, and the ousting of Hewlett-Packard's chief, Leo Apotheker, in the wake of his bid for software company Autonomy. Here to discuss the trends so far and to tell us what could be in store for 2012 are Hernan Cristerna, Head of M&A for Europe, Middle East and Africa for JP Morgan, and Adrian Catley, Pan-European Equity Strategist at Citi. Thank you both for joining me. Hernan, I'm going to ask you first. What do you think is going to be the biggest lesson for companies from their experience of M&A so far this year?
I think the biggest lesson is that even in this environment, markets are ready to reward M&A activity. They're ready to reward activity that is disciplined and that is focused. In our experience, deals where there has been a pursuit of activity of earnings in growth markets, accessing new technologies, that has been rewarded by the markets. And in fact, overall, when we looked at the 20 largest deals globally, we've seen a positive market reaction to those deals. So I think that overall we're encouraged that despite the current market conditions, focused, disciplined M&A can be rewarded, is being rewarded by the markets.
And if you were a betting man, in 2012, what do you think will be the busiest, most interesting sectors and regions globally?
I think M&A activity will continue to be driven by North America. I think that the potential of in-country consolidation can create many value opportunities. I think that overall globally commodities, oil and gas, metals and mining, will drive activity, and overall we'll continue to see an increase in inbound activity coming from from BRIC countries, from Asian countries that increasingly have been looking at European opportunities, but I expect increasingly will now expand and look also at opportunities in North America.
Adrian, as a strategist, you might have a more sort of fundamental view. What are your expectations for 2012?
I think broadly M&A historically tends to follow where the money is. So the sectors where it's most likely to happen are those where they've got very strong balance sheets and where companies are making high margins. So historically that points to the US more than Europe, to follow what Hernan was saying, but also it would suggest things like oil services, tech, where margins are high and balance sheets are very strong.
The Eurozone crisis has been a big stumbling block for deal making. Hernan, when you've been discussing deals with boards and you've been considering, they've been considering their options, how much of an issue has it been?
Obviously, it's an issue disproportionately so for European companies. I think that the good news is that there is a dislocation between corporate earnings and market valuations. And I think that we have seen that boards have been confident, driven by their actual corporate results, and they've been able to extract valuation opportunities because we are saying that the market in our experience is not fundamentally valuing opportunities correctly. I think the concern that we have is that at some point in time, everything that's happening in the Eurozone is going to have an impact, could have an impact on corporate earnings, and therefore that confidence is going to disappear. The other effect naturally is that in terms of inbound interest for European companies, if companies that are fundamentally exposed to euro only, I think the level of interest is going to wane. I think that the opportunities in Europe are going to be based on those companies that have a significant earnings exposure to growth markets.
Adrian, at Citi, you have a view that companies should be buying back their own stock, maybe then issuing stock for M&A. Why is that?
I mean, I think at its most simplistic, the average fund manager is not getting any more money through the door. Equities have been a disappointing asset class for a decade. So if fund managers haven't got any money, the challenge for them is how do they deploy the limited capital that they've got? That means if you're a company trying to issue shares, you're coming up against a pretty tough backdrop from fund managers. They want the money back from the companies. And so we think that those companies that can return money to shareholders will, one, get rewarded by the market, but secondly, it's also one of those things that will allow fund managers then to reinvest.
My last question has to be, what do you think for investor sentiment next year? Do you see it changing?
I think investors will remain nervous. The shocks of what's happened in Europe over the last 12 months will take time to heal. One of the consequences of what's going on is undoubtedly much tougher credit conditions within the Eurozone. That means that earnings are going to be under pressure. I mean, we think they'll fall 10% next year. That's a pretty tough backdrop for people to get confident at, whether it's the corporate sector or investors.
I'm sorry, that's all we've got time for. Adrian, Hanan, thanks very much for joining me. So it's fingers crossed for a more positive 2012. If you would like to read more about the subject, you can find the latest Deals and Dealmakers report at ft.com/dealmakers, and there will be more to come next year.